Hi and welcome to Swissquote's Daily Market Talk. It's Monday, March 10th. The tariff uncertainty and weak US data continue to weigh on US appetite ahead of this week's inflation update from the US. The European stocks, on the other hand, are in demand on the back of exploding spending outlook from the European governments as a response to the US policies. The euro-dollar has had its best week in more than a decade last week, and this week will likely bring in more tariff news and also a rate cut from the Bank of Canada. So last week's tariff flip-flop and weak economic data from the US ended in tears for the US markets. The week started actually with the fear that Trump would impose 25% tariffs on Mexican and Canadian imports, remember? So that week continued with these tariffs materializing and being rolled back in a few hours and days later. And the week ended with a set of weak jobs data from the US, the first set of jobs data of the new Trump era so far, marked by mass firings at the US federal agencies that resulted in a weaker than expected NFP print on Friday, a higher than expected unemployment rate, and also a lower than expected participation rate. Now, the only bright spots from Friday's jobs data from the US were the higher than expected rise in manufacturing payrolls, as Trump is bringing manufacturing back to the US, and the slower than expected wages growth number on an annual basis that could eventually help taming additional inflationary pressures from tariffs in the US, along with the waning consumer confidence and spending, and eventually help the Federal Reserve help the US economy navigate through agitated waters. So, the US CPI update this week will be closely watched by the Federal Reserve, those and investors. Remember, the rising inflation expectations in the US keep the Fed those on the sidelines regarding their interest rate cut bets for this year. Activity on Fed funds futures actually hints that the Fed won't be able to cut its interest rates before its June monetary policy meeting, if it cuts this year at all, even more so as the Fed's Jerome Powell said on Friday that the US economy continues to be in a good place. But he is not very much known for seeing things coming, really, does he? So the rising recession bets for the US economy due to Trump's aggressive international and tariff policies call for interest rate cuts, that's for sure, although the rising price pressures in the US that also come along with these tariff policies is a drag anyway. So this week, analysts actually expect the US to print a slightly easing in February inflation figures on both monthly and annual basis. So if that is the case, if the CPI update from the US this week points at a number in line with expectations, or ideally softer than expected, then the Fed those could eventually step up their rate cut bets for earlier than the June monetary policy meeting for the Fed. The latter could further pressure the US two-year yield that best captures the Federal Reserve rate expectations and further weigh on the US dollar across the board. The US dollar, which has had one of its worst sell-offs since a while, mind you. It could also give some support, on the other hand, to the major US indices, which were hit by their worst sell-off since the Federal Reserve's tightening policy peaked in 2023. If it's not the case, however, if inflation looks stronger than expected, then the market mood could further sour and the sell-off in the assets would continue, but the sell-off in the US dollar could continue as well. Well, the S&P 500 dropped more than 3% last week, tested the levels below its 200-day moving average, but managed to close last week above this level still. Nasdaq 100, on the other hand, lost nearly 3.30% last week, fell below its own 200-day moving average, but closed the week just below this level. Then the Dow Jones Industrial Index declined 2.40%. The mid-caps lost more than 3.5%, while the small-cap Russell 2000 2000 index dropped more than 4% during the course of last week. Note that this is the complete opposite of what was broadly expected to happen by investors. The small and medium-sized stocks in the US were supposed to flourish, remember, on America First policies, and the US dollar explode to the upside. Well, remember that? It's not happening at all. Instead, it is the euro that's shining like a new penny this year, along with the European stock markets. In this respect, the euro dollar has had its best week since more than a decade last week, and that despite a 25 base point cut from the European Central Bank at last week's monetary policy meeting. The pair started last week at around 104 level and rocketed past the 108 level as the European countries, and that's starting with Germany, while they threw their budget discipline just out of the window and announced massive spending to strengthen their military and security, as the US under Donald Trump decided to pull back its support. So the European yields jumped last week on the exploding spending plans that also tamed the dovish European Central Bank expectations, remember, as the ECB chief Christine Lagarde also hinted at last week's presser that the bank was approaching the end of the monetary policy easing after 6 rate cuts, and the Stoxx 600 index hit a fresh all-time high level, although the index closed the week down by 0.69%. And the cherry on top of it, the fourth quarter growth data from the Eurozone surprised to the upside, adding to the surprises of this year for the Europeans, and strengthened the view that growth in Europe could gather momentum, while growth in the US will probably slow, and it could slow dramatically. Anyway, the rotation trade from the US toward the European assets is set to continue in this context. The euro dollar will probably test the 110 psychological level sometime in the coming weeks in the foreseeable future, but in the short run, note that we have quite a hesitant, quite a doji start to the new week. The RSI indicator actually confirms that the euro might have been purchased just too fast and in a too short period of time, and it could soon be time for some downside correction. But the price pullbacks could be interesting opportunities for the Eurobulls to build longer positions on the strong convergence trade from the US to the European stocks on US-Europe growth outlooks that are converging together. Elsewhere, well, we woke up to the new week finding out that Mark Carney, the good old Mark Carney, the ex-president of the Bank of Canada and the ex-president of the Bank of England, just had a landslide victory in Canada this weekend and will replace Mr. Trudeau as the next Canadian Prime Minister. Isn't this big news, guys? So Carney actually plans to respond to the US tariff attack with retaliatory tariffs. That's one thing. But also, he wants to implement economic reforms that include tax reductions and the promotion of innovation in Canada with the goal of reducing dependence on the United States. Now, the currency markets didn't give a significant reaction to the news that Mark Carney will be the next PM. He could actually stay not too long in office. The loonie was rather pressured by the falling oil prices this morning instead. In the medium run, we could eventually see the loonie gain some color against a broadly paler greenback if Carney or someone that comes after him successfully counters the US trade attacks. But in the short run, note that the selling pressure persists for the loonie, and the Bank of Canada is expected to trim its interest rates by another 25 basis points when it meets this week on Wednesday. Elsewhere in China, the week actually starts on quite a sharply negative note, really, as the latest inflation update from China show that consumer prices in China fell the most in more than a year. Ouch. So the Hang Seng Index extend losses to more than 2% at the time I'm talking here this morning. But note that the index rebounded close to 30% since the DeepSeek news broke in January. And the low valuations of these Chinese technology stocks after years of heavy sell-off, along with promising AI news and the ample support from the Chinese government, will probably bring buyers in at the depths. So I expect the Chinese equity rally to extend from the actual levels. Overall, this week is expected to bring in more tariffs. The Chinese tariffs actually on US agricultural and some Canadian products will start from today on, while the US steel and aluminum tariffs will be live from Wednesday. So have a nice week, everyone. This is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.